I personally make a quick analysis of the stocks I'm interested to buy using Yahoo Finance. So yesterday we had looked at ETFs or index funds and how to decide which one to buy. So first of all, of course, if you are not member of my Patreon blog yet, I highly recommend you signing up because there you will learn how to make a portfolio and what percentages of small cap, large cap, mid cap, of what percentage of investments you should have in that specific portfolio. And based on that, you can move on into deciding which index funds, which ETFs, which stocks you want to buy to match that portfolio and to match the strategy you are using for investing. So for today's example, let's use Vanguard S&P 500 Index ETF. This is perfect for a large cap growth section in your portfolio. It is a large cap growth investment. It's an index ETF, and let's quickly get into it. So first off, of course, you look at the graph. I press on max. I have a look. When did they start? Okay, they started 2012. But they didn't really experience a recession yet, but you can see it started off at around $24, and 8 years later, even with Corona, the big dip here, we are at 70. So which is really, really good. I think even if there will be a recession, it will probably be a little bit lower than Corona, probably around the $40 here. And that would be just another opportunity for you to even buy more. But this ETF right here is a perfect starter for you for a base for your portfolio. So just based looking on the graph, it looks really good. It recovered fairly quick. Within half a month, we can see it jumped up from just about $60, $58 back to $70 very quickly, and back to almost what it was before Corona. So based on the graph, we can see it's really good. So the next one I'm looking at is the expense ratio. So the expense ratio is 0.08. Vanguard has one of the lowest expense ratios out there. 0.08% is really good. That is because this is not a actively managed fund. It is an index ETF. The portfolio is preset, and basically a robot does the trading, or the robot does the management of the fund. That's why it's super cheap. There's not a real person behind it. I recommend ETFs only for large cap, maybe mid cap companies, but if you investing in small cap, if you're diversifying into small cap, I do not recommend buying an ETF because they tend to be very volatile and they need active management either from you or by a mutual fund manager or by someone else you pay to manage your small cap funds. The next thing I'm looking at when I analyze a stock or ETF index fund before I buy is I look at the beta. So for everyone who doesn't know what the beta is probably the most important thing that you will need to know before deciding to add it to your portfolio. So beta measures basically how volatile your investment is. So this one has a beta of 0.98, almost at 1. So a beta of 1 would be correlating exactly with the movement of the market. A beta lower than 1 would be moving at slightly less volatility than the overall market, and the beta of over 1 is more volatile than the overall market. So the beta basically just matches and just matches the overall market. The S&P 500 can almost be seen as the overall market. It must have a beta at around 1 because it moves exactly with the market. But it's basically just a measure of how volatile your investment is. So that's the second thing I'm looking at before deciding. Then the next one, year-to-date daily total return, which is 4.11%, which is really, really good. But again, keep in mind, they are fairly new, started in 2012. They didn't really experience a recession yet. So this is really good, but just keep in mind it will change. It will be lower in the coming 2 years. Then the PE ratio, price to earnings ratio, is not available in this one because it's an ETF. So I look at the PE ratio, I don't look at it too much. The PE ratio is just for me to see how willing are investors to buy this ETF or this investment. So a PE ratio, price to earnings ratio at around 15 or 20 is fairly normal and stable. If it's in the 200s, it's probably overvalued. And if it's very low, under 15, people are just, or investors are just not that interested in it. That gives you just an indicator of that. Just to go back to the beta here, I aim to have, so you can calculate the beta not only for your individual investments, but I highly recommend you to calculate your beta for your total portfolio. That can give you a good indicator of how volatile and how risky your portfolio is. Because to be honest, everyone's risk tolerance is unique. You depends on many factors. Depends on age. Depends on status. Depends on so many factors. So I'm aiming to have a beta of 1.15. That is that's what I would consider aggressive, an aggressive portfolio, but it might not be risky or rewarding enough for someone. So they want to have a higher beta. They want to be more engaged in their investment. And if for somebody who just wants stable income, a beta of 1 or just slightly over 1 in overall beta of in the portfolio is just fine. So just keep in mind, what is your risk tolerance and what do you think? How active are you in investing and how often do you look into your investments? And what is the target beta that you want for your portfolio? Very, very important. Then I look at the yield. So the yield is the dividends you basically get. So for this one, you get 1.54% out of every share of the $78.77 per year. So that doesn't sound like much, but it will compound over time. And do not underestimate the power of compound investment. Whatever dividends you get, whatever you get back from your investment, you can use to reinvest into your investment, thus compounding it. And this is a very, very strong tool, talked about a lot from Warren Buffett, the best investor, probably the best investor in history, and a very, very powerful tool. So next one, which I look into, is their holdings. So this is very important for me too, especially when you're building your portfolio and you want to diversify. So first off, they consist of almost only stocks. And what is this? Maybe one single bond for security, maybe, or to instead of cash, they're probably holding a bond here. But it's all preset. It's a final portfolio that gets the same amount of investment every month and is not actively managed by somebody. So that's why most of it is just stocks. There's no cash. Instead of cash, there's just this 0.01% of bonds. Then the sector weight. So we can see here the biggest ones are technology, which makes it automatically a growth stock. Then we have healthcare, which is really a good sector during bad times when we're going into a recession or just coming out of recession. Technology is really good, a really good investment when you're just getting off from a recession, when we are recovering. Then the third, we have financial services, which makes it stable. So the difference between large cap growth stocks and large cap value stocks is that financial services are mostly what we call value stocks, whereas technology and things that have potential to grow, think of the internet, think of technology constantly changing, would be considered growth stocks. So they have quite a bit of financial services there, which gives this whole thing some stability, which I really like. Then we got number 4, consumer cyclical, and basic materials, consumer defensive, and everything else, industrials, everything else. Um, on my blog posts, I teach how you can sector rotate your portfolio and what sectors do well in what, so to speak, season of the economy. So just like a sec technology does well after the recession, for example, for energy, it would do well just at a boom, and going, yeah, utilities, energy is good at a boom. Healthcare is good in a recession. Financial services are good just when the recession is over, because people are willing to start getting mortgages again, start buying things again. So financial services will go up, and you can learn all this in detail on my blog, where I post 3 to 4 times a week. The link is in my bio. Just check it out and have a look. And people who used it, it helps a lot. And then the next one we can look at is probably the performance. So we saw the year to date daily return in 1 year, in 3 years return, it's 13.23%, which is absolutely great. But again, keep in mind they didn't face a recession. They didn't live through a recession yet. So this will probably be more like 11% or something for 5 years daily return. And you can look it up here, how much return they made 2019 and historically. So it seems it was always positive, making it a really good investment in my opinion. And this is basically it. This is what I do when I assess the basics of a stock I want to buy, or ETF or investment I'm always gonna do the simple analysis with these numbers. So it is very important that you know these before you buy anything. If you are buying an individual stock, you have to dig deeper. There will be a section here for financials and look at the financial statements and how good the company performed. But for ETFs and index funds, I think reading, having the basic analysis and just reading maybe in forums what people experienced with it, what people say about it, should be enough for you to make a wise decision of if that's a good investment or not. For individual stocks, it's a little bit different story. You have to dig in a little bit deeper, look into the financial statements, and make sure it is really a company that you really, really want to invest in. Otherwise, stick with index funds and ETFs. Those are the no-brainer investments for you, especially when you're starting out. So if you like this video, if this was helpful, you can learn more on my blog. Link is in the description. I wish you would get in contact with me, and I would set up an interview with you if you want. Just message me, direct message me if you have any questions, and sign up for my blog and become a lion yourself. I would be really, really happy, and you would support me enormously by going on Patreon and reading my blog. That will just give me so much motivation to do more of this. And yeah, thank you so much.